Hello and welcome everyone to our This or That series, a subset of our regular Backpack to Briefcase episode here at the Huntsman School of Business. My name is Nicole Barfus and I am one of our career specialists here at the school. This presentation is for students who are curious about what career options are available from someone majoring in finance. In this episode, our presenter, Koller Lang, will discuss the similarities and differences between investment banking, venture capital, and private equity choices versus corporate finance. After a brief introduction, I'll hand the time over to Koller to present, and then we'll go over some questions. As an introduction, Koller currently supports an M&A team at Brady Plus, a Jan Sands distribution business. Prior to joining Brady Plus, he worked at Lakeshore Partners, a private equity fund based in Salt Lake City that focuses on business services and in the industrial sectors. His career began in investment banking at Logan Growth Advisors. In addition to his professional roles, Koller serves as the president of Redfish Consulting Partners, a nonprofit dedicated to supporting small and growing nonprofits in their strategic journeys. He holds a bachelor's of science in finance from Utah State University and is a member of our Young Alumni Board. Koller spends a lot of time with our IBPE scholars here at the Huntsman, and he and his wife Bailey have set up the Lang Family Endowment Scholarship. Koller also teaches an investment banking class at the Huntsman with Professor Windor. On a personal note, Koller and his wife split their time between Sun Valley and Salt Lake City. He enjoys trail running, mountain biking, and fly fishing with his golden doodle, Harvey. Welcome, Koller. We're so excited to have you with us here today and to hear your insights and advice to help our students make a more informed decision on these career paths.
Of course, I'm excited to be here. Love talking about finance, one of my favorite things to talk about, oddly enough. So it's going to be good. I'm really excited to talk about it. Like you mentioned, my experience has been through investment banking into private equity, and now I'm working in corporate development and more in the corporate space. So hopefully I can give some good insight here, and it can be valuable to the finance students. It's something I wish I had when I was going through undergrad. So I'm hoping I can give some help and some advice here today.
Great. Okay, I'll start your presentation.
So I like to do it when I give this and when I talk about this, I like to walk through it because there's so many different pieces that go into it. The question, I love the topic. It's this or that, investment banking or corporate finance. If I was in undergrad and I was a freshman or sophomore, my first question when I heard that would probably be, well, what's corporate finance and what is investment banking? Both sound fantastic, but I have no idea what they are. And so when I was thinking about, how do I talk about the difference between the two? I think I came up with, I want to walk through the life cycle of a business. And I want to show students how a company gets to be, a large public company. What is the process of getting there? And so I'd love to walk through this. This is one of the classes we do in Finance 4495, is we start with an owner. So I'm going to jump right in. So we got an owner here, okay? I love to get background stories too, so it makes it applicable. And these are all real background stories. That's the best part about it, is these are stories that I've actually seen or I've actually worked with. And so hopefully they can give advice and help students understand, that these are applicable, these are real. So with that, you have an owner. A lot of times what we see as an owner is a father has ran this business from the 1920s all the way to the 1980s, started getting tired, but maybe their son or daughter just graduated from university. And they run, for this case, we're going to say a small bottle manufacturer. So they manufacture blender bottles. And the dad has done this for years, and the company has grown, but it's still relatively small. I would say it's probably 5 million of revenue and maybe $1 million of EBITDA. So generally a pretty small company, but a good sized company. And let's say, as we're speaking to Utah State, let's say I was based out of Logan, Utah. So this owner takes over the company after graduating from undergrad. And the first thing the owner does is they start selling. They know everyone. They know how to use that's. We'll use a applicable example. They know how to use TikTok. They know how to use Instagram. And all of a sudden, there's this large demand for all their blender bottles, but they don't have the cash. They're a small company. All their money goes either into paying themselves a salary so they can live the life they want to live, or paying other family members that work in the business, or paying for the inventory they have currently. So what do? Well, first thing this owner is going to do is he's going to go to the bank and he's going to say, hey, bank, a commercial bank, okay? Just say, can I borrow some money from you? And the bank is going to say, you know what? Okay, you've been around for years. You haven't been really risky. I know your father really well. Here's some money. So there you go. The owner gets some money and they owe the bank money. So this is the owe the bank money. Now, that right there is a position in finance. It's not corporate. It's not investment banking, but it's commercial lending. There's a commercial lender that went through that and said, okay, I believe that we can lend money to this company and we'll get money back. So that's the first position. Now, this owner uses this money and they use it to buy more inventory, hire more salespeople. They call up Utah State. They say, hey, Utah State, I want to service all of your bottles across all of your locations across the state, right? You have one in Moab, you have one in Brigham City, you have one in Logan. They accept it. So Utah State becomes their biggest client. They make a lot of money. They're able to pay this loan back. Okay, so they pay the loan back. Everything's good to go. Now, the small manufacturing business became big. Okay, so we're going to say it's a big business now. It's just a manufacturing business. It's grown because they've been successful in getting capital, utilizing that capital to grow. Now, the owner says, I wear a lot of hats. I sweep the floors. I do HR. I sell to universities. And I also, run the finances. I don't know how to do all of this. And now that we're talking to banks, people are interested in buying our business, I don't know what to do. This is the first role of corporate finance, okay? So they'll hire a financial analyst. And they'll say, hey, financial analyst, will you come into my company and will you evaluate my business? Will you look at the cash flows? Will you look at the balance sheet? Will you understand our net working capital, our accounts receivable, our accounts payable? And will you help me understand if my business is profitable or not? And that's the first step. And that's corporate finance. So corporate finance, we'll get into this later as well, but it's within an industry. So in this case, corporate finance is within a bottle manufacturer. Okay. And with this financial analyst, they're able to go to the bank and say, hey, look, actually, we have better numbers than I originally thought because we've done all the numbers. I've cleaned up the accounting books. I've done the bookkeeping. I've worked with our vendors who are going to, we owe money to, and our clients who owe us money. And we've made deals with them and everything works out and we have more cash than we thought. Go to the bank again. And so the financial analyst goes over to the bank and says, hey, bank, here's our numbers for one specific company. Here's our numbers. Will you lend against them? Will you give us more money so we can grow? So that's what corporate finance, at the very bottom, that's what they do. They're going to work for a specific company, and then they're going to use their knowledge of that specific company, specific industry to optimize the finances for that business. And in this case, now there's many cases, and so this is very broad. Corporate finance does a lot. But in this case, the analyst went to the bank, got more money. Okay, so we got millions of dollars here. We use that millions and millions of dollars to go out. Sadly, we go to the university that's down south. We ask them, hey, can we use bottles for all of your schools as well? Maybe we go to our competitors at Boise State and we say, hey, Boise State, maybe we can sell bottles to you, and this company grows. Okay, so we get all the universities and this company grows. Okay, and it's grown because we had a financial analyst understand where our numbers are, go to a commercial lender and get capital, and then that financial analyst advised the owner on how to allocate that money to grow the business. Okay? There's a lot of things that capital can go to. It can go to marketing. It can go to employees. It can go into CapEx. Are you going to build a bigger building? Are you going to buy more machinery? Well, what are you going to do with this money to optimize the business. And that's what a financial analyst does. They understand that growth process. Okay? So they utilize this money. Here they owe the bank a lot of money now. Everything's good and dandy, right? Now, you're always going to be pulling from the bank now. These are growing, so they're always going to be pulling from the bank. Okay? But they get to a point where the owner says, I've been doing this for 20 years now, 30 years, whatever it may be. I'm 45, I graduated when I was 22. I'm 45 now. My daughter's about to go off to college. I really don't want to keep working in this manufacturing business. It's taxing. My father owned the business. I owned it. My grandpa was involved in it. But I'm just ready to be with my family. So what do I do? At that point, this owner has a great profitable business. It's obviously grown because they've got a lot of universities. But the owner is a master at selling and operating. The owner is not a master at finance. The owner is not a master at selling its business. The owner doesn't even know where to go for this. And that's very common because the owner's so focused on bottle industry. What inventory, what are our raw materials we're sourcing. That is what the owner's been thinking about. And how do we sell to these universities? What do these universities want? Do they want a white label? Do they want to put their logo on this bottle? Those are the questions the owner's thinking about. So when the owner gets to this, he gets stuck. He says, I don't know what to do. I don't know how to sell my business. I don't know. And you have other people coming over here. So this CFO is saying, hey, I'll buy it for $5 million. And the owner goes, I don't know what my business is worth. How do I know 5 million is good? I've never done that before. I came out of undergrad. I worked for this business. I don't know what to do. This is where investment banking comes into play. So an investment banker will be approached, and the investment banker will come over to the business and say, hey, don't talk to that CFO. Let me sell your business for you. And why you should let me sell your business is because I know everyone. I know all of your small competitors who can buy you. I know all the big competitors who want to buy you. I know all the financial buyers. So private equity, venture cap. I know all of them. They're all my best friends. We go on trips. We go skiing in Vail together. We're good friends. You should hire me. And that's a pitch, right? And in that time, investment bankers will give the information. So the owner says, let me actually step back real quick. The owner says, oh, you know everyone. Well, talk to my financial analyst. And so the financial analyst gives all of the material. And when I say material, I mean books, financials, different information about the numbers, how profitable the business is. So the financial analyst gives all this information to the investment bank. The investment bank gives it to their analyst, and their analyst goes and chops it up over the weekend. Because remember, they're trying to win this deal. You have a CFO right here that's saying, hey, don't talk to that investment banker. He's in a shiny suit. Don't listen to him. Let me buy your business for $5 million. And the investment banker is saying, hey, don't sell to him. I can get you more money. I can get you what you want. So you should listen to me. And that right there is you're building this competitive tension, and this investment banker has to win the deal. We'd like to call that winning the mandate. And so that puts some fire under the investment banking industry. It's not one that you can say, oh, I'll get to that Monday. No, you have to do it right now. Everything is right now. Because if you don't do it right now, what if the owner goes to sell his business to someone else? And then you lose on all those fees. And so it creates a dynamic where investment banking is always go, 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 go. Because it's to get fed, you got to kill, right? It's one of those things where you got to go hunting all the time. Very similar to sales, which investment banking is. It's selling. You're selling a business. You're not selling a product. You're selling a business. Okay. So the owner says, you know what? The financial analyst, I like you, shiny suit. You took me out to a great dinner. We had a wonderful time. You flew me out to Vegas. We had tons of fun. I loved the hotel. I loved the dinner we had. But I think you know what I want here. So I'm going to have my financial analyst give you all the information. The investment banker then gives it to their analyst. Their analyst goes, chops up the number and says, oh, you know what? I ran the numbers and the business is actually worth $10 million. So we doubled the value by putting it together in a better package. And now we're going to go find a buyer that's going to pay a premium for this because this is the asset they want. So thank goodness I didn't sell to the other local guy, because now I can go make double the money. All right. So the investor goes back, and the investor's first thing he's going to do is he's going to go back to this guy and says, hey, I know you want to buy it for $5 million. We say it's worth $10 million. The guy says, oh, get lost. I don't want to pay for that. Okay, that's fine. Goes to the next business. Hey, do you want to buy this? Hey, do you want to buy this? Okay. These businesses, these competitors, small, big, I said small here for later, but these big or small, they go, oh, okay. We'll look into it, but I really can't pay $10 million. I only can pay $8 million. And this investment banker gets all these bids, and then finally goes over to his private equity investors. And he says, oh, hey, Jimmy is a private equity investor. Hey, Jimmy, we used to work together in investment banking. I think this asset's really good. And when I say asset, I mean this company has great relationship, long-standing history, good connections within the industry. You should buy it. He looks at it and he says, okay, well, let's go out together and view it. So they all go out together and they view the business. Okay, so private equity goes out there. They all view private equity. At the end of it, private equity says, you know what? You're right. We really want to buy it. We'll buy it for $10 million. That's what you said. The banker says, you know what? We actually had another bid come in and it was $11 million. Got off your price. And so private equity, and they go back and forth arguing. What is the value of this business? What should we pay for it? Is it really 10? Is it 12? There's enough competition now because the banker went around and called all of his friends. So everyone knows it's for sale. So now it's driving this demand for this asset. And that's an investment banker's job. They don't work for the business, technically. They're not in the business. They know they're not selling bottles. They're not working with the manufacturer. They're not working with the suppliers. They're not working with the vendors. None of it. That's all the financial analysts. Financial analysts, they're communicating with their vendors on what is AR, what's AP, customers, vendors, all that. They're working on AR, AP, networking, capital. They're trying to understand what are their books, what is their cash flow, how is this business operating, do we need to refinance our debt? All of those things are within business. The investment banker isn't really looking at that. They're looking at a number called EBITDA, and they're trying to build materials to market it, okay? And so they end up selling it. And they end up selling the business. Private equity buys it. The banker was good enough to talk him up to, let's say, $12 million. So this owner made a ton of money. Woo! And so now he becomes this thing called high net worth individual. Okay, so he just got paid millions of dollars for his business. Okay. Well, what does he do with all that capital? Right? He just made millions of dollars. It's like, I already have a boat. My family, we live in Logan, Utah. I just made $30 million. What do I do? He goes, you know what? The private equity investors I just talked to, they seem like they're really smart with their money. Maybe I call them up and see if I can invest in them. The private equity investors say, of course, you can invest $20 million in us. Bada bing, bada boom. Okay. So private equity investors just got $20 million. Okay. And so then the private equity investors are like, whew. Well, the high net worth individual says, I'll give you this money, but you have 10 years to give me my money back. So I'm going to give you 20 million, but in 10 years, I want my money back, and I want it higher than when I gave it to you, a lot higher than when I gave it to you. I'd be hoping for, if I gave you 20 million, I want 60 million back in 10 years or something of that sort. Right? That's what I want back in 10 years. So remember, the private equity now owns his business. Okay. Usually at that point, they'll pay off the bank loan. Here's the money back to this bank. They don't own anything. Cash-free, debt-free deal. Maybe private equity. Private equity you would usually put debt on, but we're going to ignore that for this case. So you have this manufacturing business, but there's no CEO because the CEO left, and now he's a high net worth individual. He's retired. He's hanging out with his family. Who runs a business? Well, the investment banker's not. Private equity investors are not good at operating businesses. They're good at investing. Their goal is financial engineering. We find a business that's undervalued, or we find a business that we can create additional value in, and we purchase that. That's the key. We don't go out and operate a business. I'm not going to be in the trenches doing that. I'm not good at that. I'm a private equity investor. I'm not an operator. So they're going to call up one of their friends who has experience operating. Maybe this is a financial analyst that's worked their way up the ladder. Maybe it's someone that worked their way up the ladder in the industry. They say, I know the manufacturing industry, auto manufacturing industry better than anyone. Hire me as an operator. Well, that's a pretty compelling story because this financial analyst knows the ins and outs of all the financial numbers, start to finish. They know who the vendors are. They know who the customers are. They know how the accounting books look. That's a good choice. So they go out and they find someone who used to be a financial analyst, but now they want to be in the operations. So they don't want to just look at the numbers. They want to operate the business. This happens all the time. I've seen it before. So they bring in a business operator. Okay. So this business operator, someone with past experience, probably some sort of financial past experience, because remember, private equity is a financial engineer. Their goal is to engineer the optimal return. Not to operate well, but to engineer the optimal return of their cash flow. So they want an operator that understands their finances. So that's why they'll look for someone who's been in corporate finance before. Usually these operators are older people with more experience. They've been in the industry for 10, 15 years. They did some time in some sort of financial controller space. So they're able to show they can operate this business. Not the investment banker, not the private equity. Now, I want to talk about one more role. You have this business operator, and then you have financial analyst. This business is huge. Remember, we've got all the universities in the West Coast, so it's getting bigger and bigger by the day. Okay, and we have private equity putting more and more money into it. Okay, they're saying grow. We need to give the high net worth his money back in 10 years. This is where you get a split within corporate finance. You have a financial analyst who's working on accounts payable, accounts receivable, items like that. Generally, they're very accounting focused. And then you have FP&A, financial planning and analysis. And that's someone that's forecasting for the future. Where are we going to go? How is this going to visually look? Can you present this information to me so as a business operator, I understand what I should be thinking about? This business has gotten so big, the private equity says, I don't even know where we stand. Like, where are our finances? Someone needs to make them look pretty and present them to me every month. That's where FP&A comes in. And FP&A will be considered corporate finance because they work within a specific industry. Now, one thing you're going to notice is that these people report to the business. These people report to the high net worth. And these people have to hustle to make money. And this is where you start to see a divide of work-life balance, because investment banking is going to be hustling to make money. Private equity is hustling to return capital, to return money to high net worth individuals. While the businesses, yes, they want to grow, but they're really just growing for their own entity, right? So it creates an opportunity for them to have a little bit better of a work-life balance. Still working on the numbers, still supporting investment banks, still supporting private equity. That's all a part of it. It's all part of the ecosystem. But they're working for one individual, and they're meaning the one company, and they're more focused on that. Okay. So this business operator, I guess I have one. Earlier I said I have one more position, but I'm going to add one more, and that's where I currently sit in my role. My role is corporate development, and so where we got here. So let's say this. So now we're actually going to do something applicable. This might have been, Brady Industries, the company I currently work for. This might have been them 4 years ago. They have a financial analyst, they have a private equity investor, they have a business operator who's amazing and well-respected. They have good FP&A team, so they understand where their numbers are. But they can't call enough universities. It's just way too hard to call the universities, fly out to the universities, market the bottles, buy more inventory for those universities, store the inventory, find a warehouse near those universities. Very difficult. So what they decide to do is they say, I'm going to go buy small competitors. Rather than going to an investment bank and saying, will you buy a competitor for me? As a business owner, because a business operator is too busy operating. They're going to create a team called the corporate development team. And this team is internal, but it sits on the outside, right? And it sits on the outside because its only job is to go call other sellers and say, hey, the capital the private equity investors gave me, I'm going to give you if you join my team. And this job, the reason we do this is because, let's say University of Florida calls me. Well, we're in Utah. How do I ship bottles from Utah to Florida all the time? I can't. I need to get a warehouse in Florida. Do I want to build it? Have a development project, get permits from the city, do all these things? No, way too difficult. So I call a corporate development team. They go out and they acquire the business. They acquire that business, and then all of a sudden I own a DC, a distributing center in Florida, and I don't have to go through the work. So that's an overview of why you have investment banking, private equity, and then you have corporate development. They all work on M&A transactions in different parts. And you kind of see a degree of intensity. Investment banking, very intense, go, go, go. Because you have to win a deal to make money. Private equity, a little bit relaxed. You already have the money given to you, but you have 10 years to allocate it. So you have somewhat of an eager, it's kind of starting to tone it down a little bit, not super eager. And then you have corporate development where your business is already standing. You got to acquire more businesses, but your business is still operating if you don't. So it's a little bit better of a work-life balance in some sense. Things can get busy, obviously, but in some sense, it's a better work-life balance. And then one step further, you have financial analysts who are working in the industry. And so it's not a, eat what you kill. It's your business is already making money for you. So you can just make sure you continue to work on your business. And that's why you see the progression of work-life balance. And so hopefully that was the end of my presentation, but hopefully that is something that helps students understand, the difference between all the jobs, roles, and types of careers you can have within finance. So Nicole, what questions do you have for me?
Yeah, thank you for that presentation, Koller. That really made it so clear how all those different pieces work together but how individual they are. And so I guess, for our students, maybe understanding what do those, obviously they're very different roles and they're going to have different expectations. So I know with investment banking, that can have a lot higher expectations. As you said, you can't just sit on the weekend. You've got to be going. Can you tell us a little bit about what the work-life balance might look like for the different, for investment banking, private equity, or corporate finance?
Yeah. And so I talked a little bit about this at the end, and I think that's a great intro here is investment banking, you got to go. So work-life balance is truly, it's 2 years, a commitment. You work really for 2 years. You can obviously do more, but most people stay for 2 years. And it is a lot of hours. Now, I don't think the hours are as bad as a horror story said. And the reason I don't think so is because it only comes when something's happening. So I remember being at the office and I would be there at 9, 10 o'clock at night. That's very, very common. I usually wouldn't leave until later, but I wouldn't actually have much work to do because maybe I've already sent work off to my senior to review. Maybe the client hasn't responded to my request, so there's nothing to do. Or I remember I talked about there's a financial analyst that has to give the investment banker data for it to work. And if the financial analyst doesn't give that investment banker data, well, the investment banker doesn't have work to do. And that's a real thing. Is I remember being in the office and hearing stories, oh, you're working till midnight. And then I got to the desk and I was in the office at 9, but I didn't work from 9 till 11 because the financial analyst never sent me data. Until 11 o'clock at night, they sent it out to me, and then I had to hurry up and turn it around as fast as I could. And so you see ebbs and flows throughout your day, but there's this thing, and it's a little different in the culture now because of COVID, but prior to COVID, there was this thing called FaceTime, where the joke was you always had to be there, be present, show your face. And so that's why you see a lot of the hour numbers really high, because you do tend to be at the office a good amount of time waiting for data to come in. But it ebbs and flows. A lot of people will go out to dinner, have an hour and a half dinner, 2-hour dinner during the week if things are slow. So it ebbs and flows. And obviously you come into work between 9, 10, 11. No one, it's not a show up at 9, leave at 5. No one cares when you show up. So that's investment banking. Now, private equity, it's a little step back, right? You have a little bit more time. You're making the decisions. Investment banking is trying to sell you to buy the business. Private equity, you're trying to decide if you want to buy a business. So you don't want to jump right into it. And that aspect gives you a little bit more time. And I would say most private equity associates are probably getting out to the office 7 to 9 o'clock at night. You're probably leaving. Some work on Sundays or Saturdays on the weekends. Not often, but ever so often if there's a deal you're working on and you have to close it. That's very normal. And then corporate finance, that you're the dictator of all the other processes, right? So if you don't hand off the information, the investment bankers aren't working. So you can take your time. You're the one that really dictates that flow. And so with that, you still have to do accounts receivable, accounts payable, but time's probably around 9 to 5, 9 to 6. Those types of hours are very common. Is that helpful with work-life balance?
So can you, yes. And I guess kind of along with that, how does the compensation differ in these areas, both in the short term and long term?
Yeah, that's a great question. There's a pretty big compensation gap. Investment banking is always going to pay the highest. And I say investment banking is going to pay the highest, and I'm talking that's specifically just cash. Private equity, there's a lot of other benefits that come to it with, you can co-invest, you can get carry, you can get all these other things that make a lot of wealth down the road. But cash, investment banking pays a lot of money. Obviously, it works the most hours. You're the busiest, so you'll probably make the most cash there. As a first-year analyst in investment banking in New York or San Francisco or any big name shop, you'll be making 120 to 130,000 base, and then you'll get paid about 50 to 80,000, upwards to 100,000 of a bonus. So most people are coming in around $180,000 their first year out of undergrad. That's very normal for investment banking. Investment banking also hockey sticks. So by the time you're an associate, you're probably making 200,000 base. Associate's 2 years. So if you start in investment banking as an analyst, you work for 2 years, you'll start making a base of $200,000 with $150,000 bonus. So $350,000 2 years out of undergrad. And that just continues on the hockey stick all the way up where you're making a lot of money. Private equity, I would say, investment banking associates probably making $350,000. A private equity associate at middle-sized fund is probably making anywhere from $250,000 to $300,000. If you go to a smaller market, let's say you're going to the Midwest or somewhere in Iowa or Ohio or somewhere of that sort, where there's not a big financial hub, you could see compensation being more around $200,000 for private equity. 200 to 250,000. So a little bit less in those smaller markets, but better work-life balance. Most corporate finance jobs would probably be making around 60 to 70,000 all in. The best corporate finance jobs are probably paying 90,000 out of undergrad. And they usually do the traditional 5 to 10% increase year over year. So a lot more gradual, but a much better work-life balance. Now, the second part of that question was, how was long-term goals? And I think that's a very interesting question because it all depends. Investment banking, once you set your income, you can kind of drop down to an easier role and your income stays relatively the same. So that's a great thing about investment banking or private equity. If you work in these industries for 4 or 5 years and then you go into like a corporate finance role or a corporate development role, the compensation stays the same, but your hours go down. The thing that changes is you don't get the benefit of the hockey stick. So I think the recommendation I always have for students is if they are willing and they find the work interesting in M&A or private equity, I would recommend doing that for 2 to 4 years, setting your base salary extremely high, and then come back to Utah or come back to the state you want to be at. And you have that set out salary expectation, all of that experience. You're working with tons of companies, right? You saw private equity it's just not one bottle manufacturer. You're doing 25, 30 a year. So you get a ton of experience, a ton of exposure, and that gives you the benefit of people will pay you a lot of money to come back to the state after 2-4 years. So it's not like a lot of people don't stay for life. It's not something very few people actually stay all of their life in investment banking or all of their life in private equity. You see a lot of people go into more of the corporate finance roles after a certain amount of time to get the benefit of the work-life balance, but they've already started their career, so their compensation is so high. So that's a little bit different long-term. While a corporate finance role, it's stable. You're working for the business. It's not high hours. It's 40 hours a week, maybe 50 hours on the busy season, but it's slowly progressing on income. So long-term, it might be more stable, more simple, maybe not simple is the right word, but easier for you to kind of progress through that. You get more familiarity with it. And that's a little bit different than investment banking. So hopefully that answers it.
Yeah, no, that's great. So if you went into investment banking first and then switched over to corporate finance a few years later, maybe 3-5 years later, technically that's going to be more profitable for you than just staying in corporate finance. So there is that benefit. It's just maybe a little bit more challenging to get into. So with that, let me ask you this. What can college students do to prepare for a career in investment banking or in that area or corporate finance? Is there a difference in the preparation?
Yes, very, very, very different. And well, actually, no, very different in the interview process. The preparation is the same across the board. And I guess before I answer that, I want to take one step back. And you mentioned someone could do investment banking for just a little bit of time and go into corporate finance. And there's a difference. And I've actually seen that. I've had many friends who've gone into investment banking, realized, it's just not for me. And before that, they had a corporate finance offer for $60,000. After investment banking, they had a corporate finance offer for $130,000. And they were only a year out of undergrad. And so just doing a year in investment banking doubled their salary. And so it isn't something you have to stay in for life. It is something that just gives you that initial start. And now if you love it and you want to stay in it, obviously the longer you stay in it, the more experience you get and more advantageous it is to your career. But so talking about jumping kind of from investment banking, people do it all the time. Very normal, part of the process. Now, how to prepare for the investment banking. So I think interviews are very, very, very different. But interview prep is very similar. I think everyone should go through, there's a course I offer. They go through it in the Finance 4495 class, and that's the Wall Street Prep accounting course. It teaches how all 3 financial statements link together. I know Paul does a fantastic course as well that gets students thinking about the basics of accounting, the basics of valuation. Those are great courses. And I think going into corporate finance, going into venture capital, private equity, investment banking across the board, understand how the 3 financial statements work together, understand how accounting works, understand what valuation is. That is kind of the standard. And investment banking, that's what you do. Right? If you understand what a DCF is, and I think in my Finance 3200 class, way back, this is a while ago now, I'm starting to realize how old I'm getting, but if you go all the way back there, like I would learn a DCF in that class. And so learning those are great. Those are key, right? So taking those 3200, taking accounting, I believe it's like 2010, taking Paul's class. I don't know the name of that. Those are just the basics. Taking those classes, reading Wall Street Prep, those get you prepared for the basics. And that's how you prepare for any finance interview. Now, it's very different. In investment banking, will interview you your sophomore year for your junior summer. So almost a year and a half, almost 2 years ahead. So investment banking, private equity, you have to be very proactive. You hit the ground, freshman year, you have to be doing internships. You have to be studying. You have to be ready. While corporate finance, because it's more industry specific, if you know an industry, you can go into that specific industry. A lot of those hire and recruit senior year. So you get a lot more time to understand what industry you want to go to. So same in the regards of preparation, different in the regards of interviewing process and procedures.
Yeah, and from my experience too, it seems like students need to do quite a few more internships through investment banking than you might need to do if you were going into corporate finance. Has that been your experience too?
Yes, obviously I'm very pro internship, right? Corporate finance, marketing, wherever you're going. I think getting experience, talking to other people, the biggest thing is making mistakes. I was actually talking to a former boss of mine today, and I said, if I had the opportunity to go back and do what I was doing then with what I know now, it would have been done in 10 seconds when back then it took me 8 hours. And so making those mistakes, having those fumbles is so beneficial anywhere you go in your life. So I recommend go get an internship. But in regards to investment banking, the magic number is 3. They want to see 3 internships prior to your spring semester of sophomore year. So that means you have fall, spring of freshman year, you have your summer, and you have fall. So you have essentially 4 semesters before you interview for investment banking. 3 semesters, 1 summer, but 4 kind of periods. 3 of those 4, 75% of the time, you should be doing an internship if you want to go in those. And that is tricky. That's difficult.
Yeah. Well, in closing, I'd like to ask maybe what advice you would give to someone who's unsure which path to choose.
Yeah, there's no right answer on that. And people hear investment banking, they hear the big numbers, they hear the hours, they hear how amazing it sounds, and they feel like they should go do it. I don't agree with that at all. I've seen people who say, I just want to do corporate finance, be way more successful in their life than if they said, I don't want to do investment banking, but I'm gonna push myself to do it. Really do what you enjoy, because when you enjoy something and you want to get involved in it and you want to learn and you're willing to put the hours outside of it, that's when you'll be successful. I don't think so. My advice would be no career is just surface level. Every career has more, meaning in investment banking, I was a second year analyst and I still remember reading a textbook. On my Saturday, I opened the textbook because I didn't understand why we did something in a specific valuation model. And I opened the textbook and I actually read it and I said, I need to understand this. And same thing in my career in private equity. I was always learning. And I think so many people think that wherever they go, you just kind of do the role and it's good. And I think if you have the mindset that you're always going to be learning and growing and developing, I want to do something great. I want to do something great, so I'm going to learn and develop. And then the second thing is I want to do something I love. So learning and developing is something that's easy, right? I loved finance. I told you in the beginning, I love talking about it. It's my favorite thing to talk about. And so it's easy for me to read a book and get smarter and continue to grow my knowledge. And so if that's not investment banking for you, don't do investment banking. Go do corporate finance. If you don't find corporate finance easy, go do commercial lending, go lend to businesses, right? Find what you're really passionate about and then take that extra step to learn, because I would say 80% of the people don't take that extra step. They just do the work. So if you are taking that extra step, you're in the top 20 percentile right off the bat. And the value of that, no matter if you're in investment banking, private equity, corporate finance, commercial lending, that is how you scale through your career and be successful. I don't think your job dictates your success. I think your effort does. So that would be my advice. I'm not sure if that's helpful in kind of deciding where to go, but figure out what you love.
Yeah, no, that I think that's great advice. I think it can be kind of a tricky thing because there is a lot of dedication when it comes to going the investment banking, venture capital, private equity route with all the internships and things that students need to do. So it is good to really evaluate it. And I'm so grateful for your information today. I feel like it really helped understand how that world works and the different areas that students can go into. So, Koller, I just want to say thanks again for your time and for being with us today and for explaining this to us. We so appreciate you and your contribution.
Yes, of course. And
Okay.
feel free if any students want to reach out, have them reach out. Happy to chat, happy to give a guidance. Hopefully this was helpful.
Yes, that's great. Thank you so much. Okay, everyone. I hope you enjoyed our This or That series, and we'll catch you next time.